Arul Selvan joins us, CFO with Cholamandalam Investment Finance. Let's take our conversation forward. Good morning. Thank you for joining us. Now, AUM growth for the third quarter, this quarter, has come above your guided range. Would you be looking at revisiting your guidance now that you're growing convincingly above your range?
No, see, if it has AUM growth has actually a little bit slowed down, from 47-48% to around 36%. So it will be in the range of around 30 to 32% is what we take, because this is primarily because of the base effect. We spoke about it some time back also that last year the third and fourth quarters have been good quarters. So as compared to the first and second quarter, while in absolute value we are growing, it is seemingly it looked very fast growth in the first two quarters, whereas it has slowed down a bit in third quarter. It will look like from a growth perspective, it will slow down further in Q4, but in absolute values, it will still be going up, and we should grow. We should close the year by at around 30% plus.
All right, morning. Can you also break down the momentum for us in terms of the different segments? Are there any concerns on growth ahead of the elections in any of your segments?
So in vehicle finance, the growth would be, continue to be at a moderate pace. We may not be growing aggressively on the tractor front and heavy commercials, because tractors, there has been a little bit of a stress in certain parts of the country. So in those locations, we may go slow. Heavies, because the cost of fund is increasing, and in a low yield product like heavies, we may not, grow aggressively. Used and rest of the cars and MUVs and two-wheelers, other segments we will focus in vehicle finance. LAP and home loans will grow fast because of their geographical expansion. They will grow. And in the case of CSEL, which is our unsecured portfolio, we will grow a little slower considering the regulatory forbearance on that segment. We will be slowing down on that, but it will still be a decent pace as compared to the as compared to the rest of the products, because the base there is against low. In the case of SME, we will again be a little bit slower because of the again, it's a low yield product and cost of funds. Until cost of funds moderates, we will have to keep it at a little moderate growth overall, but we will clock around 30% growth is what we foresee in the for the full year this year. And next year we should go at the range of around 20 to 25%. A little early. We have to see the election results, etc., to understand where we stand at the end of this financial year.
Right. Let's also discuss the used vehicle segment, 32% of your vehicle finance portfolio. The commentary last quarter from the industry suggested muted demand given the supply issues. Has the situation improved now?
See, this is where, when you have a wide variety of products in your portfolio, it helps. So what happens is, while there is a little bit of slowdown on the new vehicle segment, used is picking up because the price variance between the BS4, BS6 still is attractive, and so there is a large amount of used market demand for a commercial vehicle. We're trying to capitalize that. And I say used, it is a very low vintage of 5 to 6 year type of vehicle. So it has got a good potential to run another 5 to 10 years. And so we are confident that this segment will perform well. Likewise, LAP and home loan, there is a large amount of growth potential there, especially in the tier 2, tier 3 and towns where we have presence by way of our vehicle finance branches, and we are expanding there. So we see a good traction even in coming year, but we will be careful considering cost of funds and other expenses before aggressively pursuing growth.
Right, and you received an insurance broking license last year. What are your plans for scaling up this business? What kind of contribution can we expect as this matures?
See, we are selling group insurance to our customers to protect our interest also in one way, and as well as the borrowers in case of there is a unexpected circumstance happening. We were earlier doing it through our subsidiaries. Now we got the license in our name itself, so we will continue to do it. So it will increase in line with the disbursement growth, etc.
Right. So, on one hand, banks are rationing credit, while on the other, rate cycle is expected to turn. In this kind of a scenario, how is the cost of borrowing's trajectory expected to pan out?
I think from here onwards, while I may not be fully subscribing to a early rate cut, but the cost of funds may not go up from here. I think we are at the sort of a peak at the cost of funds angle, and for us, the good thing is the vehicle finance book. The yield income will continue to increase as the color of this portfolio changes with regard to slightly higher yield portfolio that we are right now doing as compared to the low yield portfolio which we were doing during the COVID period. This being a fixed rate book, that low yield book will run down, and the new book which has got a slightly higher yield will become a predominant part of the portfolio, thereby making the NIMs a little bit more positive.
Now, the last time you spoke to us, you were expecting an improvement in margins, but your NIMs have remained flat sequentially. Has the share of the repriced book not risen as per your expectations?
No, this is more a case of a slight hike in the cost of funds, considering the regulatory, intervention that came in with regard to higher risk weightages, etc. So there has been a little bit of a price, expectation increasing with regard to some of the banks, and so we needed to moderate that. So this will continue. This will be corrected as we move into the Q4, and you will see the NIMs improving in the coming quarter onwards.
Right. Though overall your asset quality has improved in most of your segments despite the natural calamities in the south in recent months, is the asset quality expected to hold up well ahead of the credit cost guidance?
The asset quality can improve further a little bit again, in a few basis points as we move. Q4 will always be a better quarter compared to the rest of the year quarters in the year. So in Q4 it will improve further, and maybe it will either hold or slightly lose its advantage in Q1 next year. But again, it will bounce back from the subsequent quarters thereafter. So you will see continuous improvement in asset quality, and I'm confident there's a headroom to do this improvement in our portfolio.
Really appreciate your time. Thank you for joining us.